Welcome to the Sojourn Wealth Management podcast. My name is Jeff Bronner, and I'm joined by Andrew Kraft and Corey Akins. We're going to be continuing our conversation today on investment basics. Last time we talked about cash and cash equivalents. Today we're going to be talking about fixed income vehicles. And the most popular fixed income vehicle is the bond. So the first question I want to ask you guys is, what is a bond and how do we make money with it?
So in general, a bond is a debt instrument. So if someone has some money and they want to lend it to a company or an agency in return for interest payments over time, and then ultimately get their money back. So just at a very high level, that's kind of, shortly what a bond is, just a debt instrument.
Yeah. And the way that they would make money is when you lend out the $1,000 or so, we'll just nice round number, your money is committed for a certain number of years, and then the company that you lent it to is saying, we're going to pay you back with interest over that time period. And so the fixed income piece of the bond structure is based on that interest rate. And so if you have a $1,000 bond, just kind of par value, and then they're paying 5%, you can say, okay, we know that we're going to make 5% on this bond over the next several years. And that's how you would generate income. And then also, as rates kind of do what they do, and we're going to talk about it, that affects the bond's actual value. So you have the income piece from it, but you also have the bond with it has an actual value that you can sell it for if you want to, and that can go up over time and so forth and so on.
Yeah. So if you have a bond getting 5% interest and current interest rates are, say, 4%, your bond looks pretty good.
It does.
And you may be able to sell it for more than you actually...
sell it at a premium, right? Yeah. Or if the other situation happens and rates go up and your bond is paying 5 and the market rates are 6 or 7, your bond, why would somebody pay money to pay the the same amount of money to buy your bond as they would those? They wouldn't, right? So you'd have to sell it at a discount.
But he asked how you make money with it.
Right.
So the interest you mentioned and then selling it at a premium. Yeah.
Yeah, so an interest-producing vehicle, and then you take it to the bond market if you want to resell it. Okay, so why is it that people oftentimes perceive bonds as being less risky? And what do we mean when we say, or in comparison to what when we say less risky?
Yeah, so the comparison comes from bonds versus stocks or equities. Mm-hmm. So when we think of a bond, it's typically coupled with a portfolio made of stocks and bonds. And so when we say less risky, really in relation to stocks. So historically, bonds have been less risky than their counterparts. And part of that is because if you have a debt instrument that the investor has lent their money to the company and that company goes bankrupt, the creditors are going to be paid first. So say they're liquidating the company and they have, the manufacturing warehouse and the items that they used to sell, and they're liquidating that, it's going to be paid out to those who had lent them money first before it goes to the owners. Mm-hmm. And that's why typically they're less risky, because your return of investment is a little bit more secure.
Yeah. We kind of often hear of people losing money in stocks if you invested in, Qualcomm or WorldCom or Quest or whatever it is. That return of capital. And then I think another way that it's less risky is just the stability of the income. So with as opposed to stocks, like kind of, again, comparing it to them, you might get income from the profit of the company, but oftentimes the interest paid on a bond, is contractual. And so that income stability, it's 5%. And so, in general, you're going to keep getting that 5% as long as you hold the bond. And so you can make plans, long-term retirement plans, for example, based on that certainty, which reduces the risk, kind of overall the risk of the plan.
Yeah. And if you invest in companies that have a good track record or strong financially, that volatility is typically going to be much lower because they have a good history of paying back their debts, right? And if you invest in those companies, the overall risk will be lower. And we're going to talk about other types of bonds here shortly, but typically that's what lends itself to the volatility or the waves kind of being less marked than stocks.
Gotcha. And so to kind of summarize some of those points, essentially because it's an obligation that the company has, either if the company goes under, you're going to get paid from the liquidation to some portion of their assets, or two, with stock ownership, the stock does well, they pay a dividend. Even if the stock doesn't do well, the company doesn't do well, they still are obligated to pay their debt obligations. And so both of those mitigating against those volatility effects. And you mentioned, Corey, and we'll jump into this. There's different, no bond is made the same. There's all different types of bonds. What are the different types of bonds?
So I think the first, classification would be the issuer. Who is borrowing the money? And I think just basic two types. Corporate versus government bonds. And so a company like IBM or Microsoft or whatever might want to get some capital to do whatever they want, build a new campus or warehouse, or I don't know, and then they'll pay interest on that, or a government just to fund their debt obligations, and so they'll lend money in the form of a bond as well. So government versus corporate bonds are kind of the first,
and they can also be foreign or domestic, right? So like you can invest in bonds overseas, so in other corporations and other governments,
like Toyota or Japan.
Exactly. So you've got even more of a diversification factor there. If you're not just investing in U.S. companies or the U.S. government, you can do that around the world.
Yeah. And Corey, you mentioned earlier the bond rating agencies, or the strength rather of the companies, and oftentimes those are determined by bond rating agencies. But that then also would be a different delineation between an investment grade, so a good blue chip or AAA, a really strong company, been around for a long time, or what are called high yield, or sometimes called junk bonds, which pay much higher interest rate to, in essence, entice or lure investors to give money to the company as well.
Because the lack of credibility there would make it a higher risk.
Exactly.
So to speak.
Right.
So when we're looking at advising folks and providing counsel with portfolio construction and things like that, how do bonds help? Where do bonds fit in with building an investment portfolio?
Yeah, they in many, many ways. So I can think it depends on like where you're at, right, in your career, in life. But first off, bonds are typically going to be negatively correlated to stocks. So when stocks go up, bonds are down, vice versa. So they create this balance in the portfolio to help with some of that overall portfolio volatility. The second way I think is, if you have people who need income or want to be in the marketplace but are more conservative, bonds are a great place to be. And then say you need income in retirement, you can have a host of bonds in your portfolio that does kick out a monthly income in addition to what you're getting from either pension plans, Social Security, whatever, or annuities, things like that. And so there's a many ways that they can be used, but those are just a few that kind of come to mind.
Yeah. I think that's the key component when you're thinking about a portfolio asset allocation. There's a lot of studies that show that the determination of the return is based on what percentage is in what different asset class. And so if you have a certain amount in bonds, you may have a lower overall return, but as you mentioned, Corey, the overall volatility is going to be a lot less as well. And so it helps you kind of maybe stay the course and reach your ultimate goal.
Yeah. And the goal may not even be appreciation. It may just be, I want a 5% yield on the income side and go from there, which brings us to another point that you can get even more specific with implementing things like municipal bonds. And so municipal bonds offer great tax benefits and oftentimes are tax-free when they kick out the interest. And so a lot of folks like that idea as, hey, I have a lot of cash on hand. I'm going to open up a brokerage account, put a lot into municipal bonds, and then that's going to pay me a tax-free amount each month that I can utilize however I want.
Yeah, great point.
That is a great point, Corey. Thank you so much, both of y'all, for unpacking this topic. I look forward to diving next into equities and stocks. I know that a lot of people will be excited to hear about that as well. Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management, LLC.